In this market specifically, in these middlemen, highly transparent middlemen markets, it's very difficult to hide the cheese, meaning the ability to get to an extremely precise valuation model is pretty easy. Basically, what happens is you grant an RSU, which is effectively W-2 income when it's realized with an expiration date. But that expiration date forces you to be public so that that RSU can be exchanged for value. And that's like a 10-year window. So then these guys have to go in and modify that date and push it out by another 4, 5, 6 years or whatever. That is a deemed event by the IRS that then creates withholding tax issues.
Right.
So you then have to withhold tax on behalf of the employees. And so that collective number is the $4 billion that Stripe is trying to raise.
So anyway, why does it matter, Chamath?
Yeah, why does this all matter? Like,
Yes.
why do we care?
Thank you. That's where we're getting to.
I posted a link. This is a 2013 interview that Zuck did with Michael Arrington of TechCrunch. And if you go all the way back, the apprehension to go public was one thing that we really anchored to a lot at Facebook in the early days. And at the time, I don't know if you guys remember, but there was these arcane laws around the number of shareholders that you could have. And I think the issue specifically was that after 500 shareholders, you have to publicly release your financials. And so we did all kinds of things to make sure we never hit the 500 cap. And we tried to push the IPO date as far out as possible because we thought that it would keep people more focused. And then in 2010 or 11, I've told this story a couple times, one of the things that I was advocating for pretty aggressively was trying to launch a mobile operating system to compete with iOS and Android. And we had put together all this work and brought in Intel and AT&T and all these people. And it came down to the fact that we needed a couple $2 billion to float this thing. And we didn't have that money. So the only solution to that would have been to go public, but it wasn't the right moment in time and Zuck wasn't comfortable with it. A year after going public, one of the things that he said publicly in this TechCrunch thing was, wow, I should have just gone public sooner. It wasn't nearly the bad thing that I thought it was going to be. And when you look subsequently at how much money they've spent in AR and VR, spending $0.25 of that cash could have given them the chance to disrupt Android and iOS in 2010 and 11, which in hindsight is obviously a no-brainer bet, right? So even though I think we at Facebook were the ones to really put this in the water table about not going public, I think a lot of startups should have gone back to first principles to really question whether waiting as long as possible actually makes sense. So I was curious about the Stripe situation. So I asked my team to do a little bit of work on how would you value this thing if it were going public. And the interesting thing about Stripe is that it operates in a really transparent middleman business. So what's interesting about Stripe is that so many of the people in the ecosystem are public. And so what that means is you can build a pretty accurate mosaic of how well or not well that business is doing by interpolating all the other data from all of these other companies that are public and are forced to report. And so there's like a couple of really interesting things that jump off this page. And so the first thing that we did was we looked at what does the future profitability look like, X of growth. And what's interesting is that you look at companies like Visa and MasterCard that are doing quite well and have done really well for a long time. But you look at this outlier in Adyen, and Adyen is probably the most obvious competitor to Stripe. And the thing that is demonstrated here is how incredibly profitable this business is and how much operating leverage they have, which means that their OpEx is relatively constrained. X of their long-term sales CAGR, what you start to get a sense of is the operating leverage that this business has. And so all of this basically nets out to three interesting takeaways. When Stripe got underwritten at $96 billion, it's this data point right here where, you see your Stripe previous round.
5x enterprise value divided by 2024
divided
sales
over
estimate.
their long-term EBITDA exactly by their sales estimate. And then if you look at the $55 billion valuation, it's down. So what it looks like is happening is appropriately so. people are doing the right thing, which is they're re-rating the stock, right, by approximately 50, 60%. But what's interesting is not where they are in terms of where they used to be, but the interesting thing is where they are relative to their most obvious competitor, Adyen. So Nick, please bring up the next one. So this is where things get really interesting because we looked at what was Adyen and what was Stripe's GMV per employee a couple of years ago before all hell broke loose in the private funding markets. And what you see is they were pretty equivalent businesses, and they had roughly the same amount of employees. But this crazy thing happened, which is that if you look at the gray bar, this is the number of employees that Stripe has. It went crazy from a little over 2,000 to almost 8,000. So a 4Xing of employees in 2 years.
4X in 24 months. They added 6,000 people. Just pause for a second on that. 6,000 people in 24 months in 700 days or so.
Right.
3 people a day.
And if you do the same calculation for Adyen, it shows that they a little bit less than grew by about 75%. And then if you look at the growth of GMV and you impute how productive is each employee, basically this is the story of what's happened to Stripe and Adyen, which is that Adyen has found operating leverage, right? So they've found and maintained incredible profitability, and Stripe has added an enormous number of employees. Now, the question is why, right? So it turns out that these guys at the top line are growing roughly the same, except Adyen actually takes meaningfully less on a per transaction basis than Stripe does. And the reason is that Adyen services these large head customers. Think big, bulky folks that have huge amounts of transactions and so as a result have pricing power. And Stripe has some of those customers as well. In fact, they just announced that they're going to process a large portion of Amazon's payment volume. But what's happened at the same time is that those kinds of deals aren't necessarily that profitable. And so you have to hire a lot more people to build a lot more features so that you can generate revenue from the long tail of customers, all of these SMBs. And this is the tale of these two companies, which is that Stripe has some head customers, but many, many, many tail customers. Adyen has mostly head customers, fewer tail customers. And so the leverage in the business is that Adyen has most of these employees in Europe, where the cost of these folks is much, much cheaper, and they have less than half the number. And so as both of these companies continue to grow, you have one that has maintained and frankly raised their long-term profit projections because they see it in the business, even at lower transaction costs, and Stripe, which is having a little bit more trouble. So I thought it was a really interesting expose. The takeaway for me is that if you were sitting inside the company, and obviously hindsight is 2020, the most profitable thing they could have done from an enterprise value perspective would probably have been to go public in 2018, 2019, because they could have raised max value at max valuation, cleaned out all these options issues, and have a huge balance sheet of cash with which to do stuff, whether it's acquisitions or other ththings. Because the thing that I struggle with is there going to be long-term profitability in all of these tail products? Because if you look in the SaaS ecosystem, and SaaS, I'll hand the ball to you, there's companies building all this other stuff, and these point products are probably pretty good too. Well, in fairness to Stripe, they were very honest about this, and they were like, we overestimated, got confident, and we overhired. And they found that all the coordination costs to Sax's point became too high. That's exactly what the Collison said in their memo. So I think that they're trying to course correct and get back to this. I think the point that I'm making unemotionally, I don't own Stripe nor Adyen, I don't have a horse in this race, is more that in this market specifically, in these middlemen, highly transparent middlemen markets, it's very difficult to hide the cheese, meaning the ability to get to an extremely precise valuation model is pretty easy. You know, this was half a day's work that we did. And the point is all this data is out there. And so it means that if you're going to go public as a company like this, you have to be quite thoughtful about how outside-in folks will value you, because the terminal buyer is very, very sophisticated and pretty smart about how to think about spaces like this. The interesting thing about that space, we talked to one of our friends at our poker game who runs a large consumer-facing business. And I don't know if you were there for that conversation off Freeberg, but
I was.
You were there, yeah. And one of the interesting things he said is, we are at a level of scale where we just bid these guys against each other, and these things tend to now be loss leaders for them, which is to say effectively that cost structure becomes really important. So your CAC becomes very important because your LTVs are capped, right? And the LTVs are capped because these companies have enough negotiating leverage to say, well, if you want my business, here's the cost of doing this business, which makes a ton of sense if you're any large purveyor of services that require payment processing infrastructure. So one of the interesting dynamics I think we're learning in this market is how it's really not a market, right? There are segments and there's embedded profitability in each segment. So to your point, Freeberg, this is the sum of at least 3 or 4 different LTV to CAC ratios, right? The tail looks very different, which is why you have to build a ton of features. And the head just wants pure play, and it's all about cost first. Because all of these guys want to pick up every nickel and dime that's on the floor, because for them, on billions of transactions is meaningful to them. It's an EPS miss or beat, right, for them, which has huge implications to their stock. This is a market that I think is going to be really fascinating.